Hi, welcome back to John Smith of Wotu. And if you're someone who pays attention to commodities, markets, or just where your money might be safe over the next few years, today's video is going to be really worth your time. Because we're going to talk about silver, not in a vague surface-level way. We're going to go deep. We're going to look at what's really happening with silver supply right now in 2026, why some of the world's largest and fastest-growing industries are consuming silver at a pace nobody saw coming just 5 years ago, and why the math of supply versus demand is starting to look very interesting, and in some ways a little uncomfortable for the global silver market. Now, before we get into all of that, I want to be upfront about something. This channel is here to educate. Everything we talk about today is for informational purposes only. It's not financial advice. Every investment carries risk, and silver is no exception. What I want to do is give you the full picture, the data, the context, the questions you should be asking, so that you can make informed decisions with your own money and your own judgment. That's always the goal here. So with that said, let's get into it. Let's start with a question that might seem simple, but actually opens up a really fascinating conversation. Is the silver shortage real? You might have seen that phrase floating around online. You might have heard people talking about silver supply deficits. And you might be wondering, is this actually true, or is it just noise designed to get people excited about buying silver? That's a fair question, and it deserves a serious answer. So let's walk through what we actually know. A supply deficit, in very basic terms, means that the world is using more silver than it is producing. Mining output plus recycled silver flowing back into the market is not keeping up with what industries and investors are consuming. When that gap exists, when demand is structurally higher than supply, that's a real imbalance. And the data that's been coming out of major commodities research institutions, including the Silver Institute, which tracks the global silver market more closely than almost any other organization, has been showing silver deficits for multiple consecutive years running into 2026. We're not talking about a tiny rounding error. We're talking about hundreds of millions of ounces of demand in excess of what miners are pulling out of the ground. Now, silver has always had a dual identity. It's a monetary metal with thousands of years of history. People have used it as a store of value, as currency, as a hedge against economic uncertainty, and that identity still matters. We'll come back to it. But what's changed dramatically over the last decade, and especially over the last 3 to 4 years, is the industrial side of the silver equation. And this is where the story gets really interesting. Think about it this way. Imagine you have a commodity that's been primarily used for jewelry and investment for most of its modern history. And then suddenly, almost overnight in historical terms, the world's fastest-growing industries start treating that commodity as an essential raw material, not optional, not easily substituted, but genuinely essential. That's what has been happening to silver. And the industries driving this are names you know very well: artificial intelligence, electric vehicles, solar energy, advanced electronics. These are not niche markets. These are the defining industries of the 2020s and beyond. Let's start with solar energy, because this is probably the most documented and most dramatic case of industrial silver demand growth. Solar panels require silver. Specifically, silver paste is used to make the photovoltaic cells that convert sunlight into electricity. The silver acts as a conductor, and it's one of the best conductors in the world. There's no perfect substitute that can match silver's performance at scale without compromising efficiency. Every solar panel that gets installed on a rooftop in Arizona, on a massive solar farm in Texas, or on a factory in Germany contains silver. And the world installed record amounts of solar capacity in recent years. Global solar installations have been exploding. Governments across the United States, Europe, and Asia have made renewable energy a central pillar of their economic policy. The Inflation Reduction Act and various green energy incentives in the U.S. alone have pushed solar build-out to levels that would have seemed almost impossible to project just 5 years ago. Each gigawatt of solar capacity requires millions of ounces of silver. Multiply that by the hundreds of gigawatts being installed every single year, and you start to understand why solar alone has become one of the most significant drivers of silver demand the market has ever seen. Now, here's the thing that makes solar demand particularly interesting from a supply perspective. Solar panels, once installed, are not a short-term purchase. They last 25 to 30 years. But the silver inside them is essentially locked away. It's not easily recycled back into the market in the near term. So all of that silver that's going into solar installations around the world right now is effectively being removed from the available supply pool for decades. The market doesn't get that silver back quickly, and as solar installation targets continue to climb, and all indications from government policy and corporate investment suggest they will, the cumulative silver demand from this one sector alone is staggering. But solar is just one part of this story. Let's talk about electric vehicles, because this is another sector where silver consumption is rising in ways that most people outside the industry don't fully appreciate. When most people think about what goes into an electric vehicle, they think about lithium for the batteries, maybe cobalt, maybe nickel. But silver plays a very important role in EVs as well. Silver is used in the electrical contacts, the circuit boards, the charging systems, and the advanced driver assistance systems that are now standard in most modern electric vehicles. Each EV uses more silver than a traditional internal combustion engine car. And as EV adoption continues to accelerate in the United States and globally, with major automakers committing to electric-only lineups, with charging infrastructure expanding, with consumer adoption growing, the silver demand from the automotive sector is not going down, it's going up, year after year. And then there's the newest and perhaps most exciting driver of silver demand, and that is artificial intelligence. Now, I want to be careful here because when people hear AI is driving demand for X, they sometimes assume it's hype. So let me explain exactly what the connection is. AI requires computing power. Massive, unprecedented levels of computing power. The data centers that run AI models, the training of large language models, the inference that happens every time you use an AI tool, the real-time processing that AI-powered products depend on, all of this requires hardware. Specifically, it requires servers, chips, circuit boards, and cooling systems, all of which rely heavily on silver. Silver is used in the printed circuit boards inside servers, it's used in semiconductor packaging, it's used in the advanced chips themselves. The build-out of AI data center infrastructure that has been accelerating through 2025 and into 2026 is creating a new and fast-growing source of silver demand that wasn't in anybody's forecast models just a few years ago. Think about the scale of AI infrastructure investment. Major technology companies, we're talking about some of the largest corporations in the world, have committed hundreds of billions of dollars to AI infrastructure over the next several years. These aren't small projects. These are massive, sustained capital expenditure programs that require enormous quantities of raw materials, including silver, and this demand layer is cumulative. It adds on top of solar demand, on top of EV demand, on top of traditional industrial uses like electronics, medical devices, and industrial manufacturing. The silver market is being asked to serve more masters than it ever has before. Now let's pull back and talk about the supply side, because this is where the real tension in the silver story lives. Silver is primarily a byproduct metal. That means most of the world's silver doesn't come from mines that are specifically targeting silver. Instead, it comes as a secondary product from mines that are primarily mining copper, zinc, lead, and gold. When commodity markets are strong and those primary metals are in demand, mining companies expand production and silver flows out as a byproduct. But when commodity markets slow or mining economics get challenging, silver supply can fall even when silver demand is rising, because the decision to mine isn't being driven by silver prices. It's being driven by the price of copper or zinc. This creates a structural vulnerability in the silver supply chain that is very different from most other commodities. Silver can't simply ramp up production in response to rising demand the way, say, oil can respond to higher prices by drilling more wells. The lead time to open a new silver mine, from exploration to permitting to construction to production, is measured in years, sometimes more than a decade. And most of the large, easily accessible silver deposits that exist near the surface have already been found and are already being mined. The new discoveries that geologists are making tend to be deeper, in more remote locations, or in geologically complex deposits that are more expensive to extract. That means the cost of bringing new silver supply online is going up, not down. Meanwhile, the recycling side of the silver equation, while important, isn't growing fast enough to close the gap. Silver recycling, which comes from things like used electronics, photographic materials, and industrial scrap, does contribute meaningfully to overall supply. But as we just talked about, a lot of new silver demand is going into long-lived applications like solar panels, where it won't be available for recycling for 20 or 30 years. So recycling can't be the answer to a structural supply deficit, at least not in the near to medium term. And this is exactly where the deficit conversation becomes very real. When you have demand that is structurally rising, driven by green energy policy, AI infrastructure investment, EV adoption, and all the traditional uses of silver, and supply that is structurally constrained, the basic laws of economics say that something has to give. Either demand finds substitutes, or supply finds new sources, or prices rise to bring the market back into balance. And so far in 2026, we haven't seen substitutes emerge at scale for silver in its most critical industrial applications. We haven't seen a dramatic new wave of silver mining capacity come online, which means the price signal is increasingly doing the work of trying to balance this market. Now, I want to pause here and acknowledge the investment angle of this, because silver's identity as a monetary metal is also part of this picture. When investors and institutions get nervous about inflation, about the purchasing power of the dollar, about geopolitical instability, or about financial market volatility, silver, along with gold, tends to attract attention as a safe haven asset. And in 2026, there are plenty of macro forces that are keeping investors alert. We've seen ongoing uncertainty around Federal Reserve policy, debates about the long-term trajectory of the U.S. dollar, and geopolitical tensions that have created a backdrop where hard assets feel relevant again to a lot of investors. What makes silver particularly interesting compared to gold from an investment perspective is the gold-silver ratio. This is a measure of how many ounces of silver it takes to buy 1 ounce of gold. Historically, over very long periods of time, that ratio has averaged somewhere in the range of 50 to 80. But in recent years, that ratio has been elevated well above historical norms, which some analysts interpret as silver being undervalued relative to gold on a historical basis. Now, the ratio can stay elevated for long periods, and it doesn't guarantee anything. But it's a data point that silver investors watch carefully, because historically, periods of high gold-silver ratio have sometimes preceded periods where silver outperforms gold as the ratio mean reverts. Here's something important to understand about silver specifically. Silver is a smaller market than gold, significantly smaller. The total global above-ground silver inventory that's available for investment and trading is a fraction of the size of the gold market. This is actually one of the reasons why silver can be more volatile than gold, both to the upside and the downside. When investment demand for silver increases, even a relatively modest flow of investment capital into silver can have an outsized effect on price. And conversely, when investors exit silver positions, prices can fall sharply, so silver is not for the faint of heart. The potential upside that people discuss comes packaged with real volatility risk. If you've been finding this breakdown useful, this would be a great time to hit that like button. It genuinely helps this channel reach more people who are trying to understand markets like this. And if you haven't subscribed to John Smith's O2 yet, go ahead and do that so you don't miss the next video. We cover gold, silver, and broader market analysis regularly, and I think you'll find it worth your time. Now, let's talk about something that doesn't get enough attention in most silver discussions, and that's the concentration of global silver supply. The top producing countries for silver in the world include Mexico, Peru, China, Russia, and Australia. Let me highlight a couple of things about that list. Mexico and Peru together account for a very significant share of global silver production. These are countries that have experienced political and regulatory changes in recent years that have, in some cases, created uncertainty for mining companies operating there. Changes in royalty structures, permitting delays, nationalization debates, labor disputes. All of these factors can affect whether a mine operates at full capacity or faces disruptions. When supply is already tight globally, a production disruption in a major producing country doesn't just affect that country. It ripples through the entire global silver market. China is also on that list, both as a producer and as one of the world's largest consumers of silver. China's industrial demand for silver, driven by its massive solar manufacturing sector, its electronics industry, and its EV production, is enormous. China produces a lot of solar panels for the world, and those panels contain silver. China also consumes a significant portion of global silver supply domestically. This dual role as both producer and consumer gives China an outsized influence on global silver market dynamics that is important to understand. Now let's think about what all of this means going forward, because that's ultimately what matters most for people watching this video. If you're someone who is thinking about silver as part of your broader financial picture, what's the framework for understanding what might happen next? The structural case for silver comes down to a few simple ideas. Industrial demand is rising, and the growth drivers, solar, EVs, AI infrastructure, are not going away. If anything, they're growing. Government policy around the world continues to push in the direction of more renewable energy, more electrification, more digitization, all of which require silver. Supply is constrained in ways that are not easily or quickly resolved. New mining takes years. Recycling can't close the gap. Byproduct dynamics mean silver supply doesn't simply respond to silver prices alone, and the monetary demand layer, investors seeking hard assets in an uncertain macro environment, adds an additional layer of demand that doesn't move in lockstep with industrial cycles. Against this backdrop, the case that silver prices could rise significantly from current levels is one that is made not by speculators trying to sell silver coins, but by serious commodities analysts at major research institutions. The Silver Institute, commodity desks at major banks, and independent researchers who model supply and demand fundamentals have been consistently projecting that the supply deficit in silver could persist for years into the future. That doesn't mean silver prices will go up in a straight line. Markets don't work that way. There will be corrections, there will be periods where industrial slowdowns reduce demand. There will be moments when the dollar strengthens and puts pressure on precious metals prices. Silver's path is unlikely to be smooth. But here's the mental framework I'd offer you when you see a commodity where structural demand is rising due to irreversible technological and policy trends, and structural supply is constrained by geological and economic realities that can't be quickly changed. That is a market where the medium to long-term price pressure is likely to be upward, all else being equal. The question for any individual investor is not whether that's true. It's whether that insight, if accurate, is already priced into the market, and what role, if any, silver should play in a diversified portfolio. This is also where I want to be honest with you about the counter-arguments, because there are real ones. The biggest risk to the bull case for silver is demand destruction. If the global economy enters a significant recession, industrial demand for silver falls. Manufacturing slows. Solar build-out slows. EV sales slow. And when that happens, the deficit can shrink or disappear quickly. Silver has historically been more sensitive to economic downturns than gold, precisely because such a large portion of its demand is industrial. In a risk-off environment where investors are selling everything, silver can get caught in that wave even if its fundamentals remain strong. There's also the substitution risk. If silver prices rise far enough and fast enough, industries have a strong incentive to find ways to use less silver per unit of output. And in fact, this has already been happening in the solar industry over the past decade. Solar panel manufacturers have been working continuously to reduce the amount of silver paste used per panel. They've made real progress. A solar panel today uses meaningfully less silver than a solar panel from 10 years ago. That's a form of demand management that limits how much any single price spike can compound. The question is whether efficiency improvements can outpace the overall volume growth in solar installations, and the evidence so far suggests that volume is winning. More panels are being installed so rapidly that even as each panel uses less silver, total solar silver demand keeps rising. As always, thank you for watching John Smith Show 2. If this video helped you understand the silver market more clearly, please hit the like button and subscribe so you don't miss what's coming next. And remember, everything here is for educational purposes only, not financial advice. Silver carries real risk, and every decision should be made based on your own research and your own financial situation. Stay curious, take care of yourselves, and I'll see you in the next one.